Last year, 25 American billionaires paid an average tax rate of 3.4%. You? If you're making $60,000 to $100,000, you're paying around 35% when you add up federal, state, payroll, and everything else. Let that sink in. They made billions. You made tens of thousands, and you paid 10 times their rate. This isn't a mistake. This isn't a loophole. This is by design. And after this video, you're going to see exactly how they do it, why you can't, and what that means for your financial future. Hit subscribe if you're tired of playing a game where the rules don't apply to everyone. My name is Sarah, and I need to tell you something that's going to make you angry. And I'm okay with that, because anger, when it's directed at the right target, can be incredibly clarifying. For years, I thought I just needed to work harder, earn more, save better. Then I learned how the tax system actually works, not how they tell you it works in high school civics class, how it really works. And once you see it, you can't unsee it. Let's start with your tax reality, because most people have no idea how much they actually pay. You make $80,000 a year. Nice round number, upper middle class in most parts of the country. You should be doing okay, right? Here's what actually happens to that money. Federal income tax. For a single person making $80,000 in 2026, after the standard deduction, you're paying about $10,500 in federal income tax. That's an effective rate of about 13%. Okay, that doesn't sound terrible, but we're just getting started. FICA, Social Security and Medicare. That's 7.65% of your gross income. No deductions, no breaks, no way around it. That's $6,120. Everybody pays this. Well, not everybody. We'll get to that. State income tax. Depends on where you live. But let's say you're in a state with a 5% effective rate. That's another $4,000. So far, you've paid $20,620 in just federal income tax, FICA, and state income tax. That's 25.7% of your gross income. Gone before you even see it. But wait, there's more. Sales tax. Every time you buy something, you're paying another 6 to 10% depending on your state. Let's say you spend $30,000 of your after-tax income on taxable goods. That's another $2,400 in sales tax if your rate is 8%. Gas tax. You drive to work. Every gallon has federal and state tax built in. Maybe $400 a year. We're now at $26,420 paid in taxes out of your $80,000 income. That's 33%. And we haven't even talked about all the little taxes hiding everywhere. Taxes on your cell phone bill, taxes on your internet, taxes on your car registration, taxes on your utilities. When you add it all up, you're easily paying 35 to 37% of your income in various taxes. Maybe more if you live in a high-tax state like California or New York. Think about that. More than a third of every dollar you earn goes to taxes. You work January, February, March, and most of April just to pay your tax bill. You don't start working for yourself until late April. And here's the part that really stings. You pay all of this before you get to use your money, before you save for retirement, before you build an emergency fund, before you invest, before you do anything. The government gets paid first. You get what's left. Now let's talk about their tax reality. And when I say they, I mean the ultra-wealthy, the billionaires, the people who own assets, not just earn paychecks. In 2002, ProPublica obtained IRS data on the wealthiest Americans. And what they found was shocking, even to people who study this stuff for a living. Between 2014 and 2018, the 25 richest Americans saw their wealth increase by $401 billion, with a B. During that same time, they paid $13.6 billion in federal income taxes. Do the math with me. $13.6 billion in taxes on $401 billion in wealth growth. That's a 3.4% tax rate. You're paying 35%. They're paying 3.4%. Let me give you a specific example. And I'm going to use a composite case based on public data because I'm not in the business of getting sued. But the mechanics are real. Imagine a billionaire with a net worth of $10 billion. Most of that wealth is in stock. Tesla, Amazon, Apple, whatever. It doesn't matter. The point is, it's in assets, not cash. This year, those assets appreciate by $500 million. $500 million. His net worth just increased by 5%. He can now afford to buy things he couldn't afford last year. His wealth grew. But here's the trick. On paper, his income is only $1 million. That's his official salary from his company. Maybe he's a CEO or a founder who takes a token salary. So what does he pay taxes on? The $500 million wealth increase? No. The $1 million salary, that's it. At the top tax bracket, that's about $400,000 in federal income tax. Sounds like a lot until you realize his wealth increased by $500 million. $400,000 in taxes on $500 million in real wealth gain. That's a 0.08% effective tax rate. 0.08%. You're paying 35%. He's paying 0.08%. And this is completely legal. This is not tax fraud. This is not even aggressive tax avoidance. This is just how the system works. Because here's the fundamental trick. The tax code doesn't tax wealth. It taxes income. And they've made sure that wealth and income are two very different things. Your wealth increases when your assets go up in value. But you only have income when you sell those assets and realize the gain. As long as you never sell, you never have income. And if you never have income, you never pay taxes. It's that simple. And that broken. Now you might be thinking, okay, but they have to sell eventually, right? They have to access that money somehow. How do they live? Great question. Let me show you the magic trick that makes all of this work. It's called buy, borrow, die. And it's the strategy that allows billionaires to live like billionaires while paying almost nothing in taxes. Here's how it works. Step 1, buy assets. Stocks, real estate, art, businesses, whatever appreciates in value over time. You don't need to start with billions. This works at any level once you have significant assets. Step 2, watch those assets appreciate. Your Tesla stock goes from $1 billion to $2 billion. Your real estate portfolio goes from $500 million to $800 million. You just gained $1.3 billion in wealth. You pay zero taxes because you didn't sell anything. Step 3, borrow against those assets. This is where it gets beautiful. You go to a private bank. You say, I have $2 billion in Tesla stock. I'd like to borrow $50 million against it. The bank says, great. We'll loan you $50 million at 2% interest. You put up your stock as collateral. Now you have $50 million in cash. And here's the magic. Loans are not taxable income. You don't pay taxes on borrowed money. Why would you? You have to pay it back. Step 4, live off the borrowed money. You use that $50 million to pay for your lifestyle, your houses, your jets, your yachts, whatever. You're living like you have billions, because you do have billions. But technically, you have zero income. You're just spending borrowed money. Step 5, repeat. When you're running low, you borrow more against your appreciating assets. The stock market keeps going up. Your assets keep growing. You keep borrowing. You never sell. You never realize gains. You never pay capital gains tax. Step 6, die. This is the final piece. When you die, your heirs inherit your assets. And here's the truly insane part. There's something called stepped-up basis. Let's say you bought Tesla stock for $1 million, and it's now worth $2 billion. If you sold it while alive, you'd owe capital gains tax on $1.999 billion in gains. That's about $400 million in taxes. But if you die and your kids inherit it, their basis steps up to $2 billion. The $1.999 billion in gains, erased, forgiven, never taxed. Your heirs can now sell that stock and pay zero capital gains tax because their basis is $2 billion, and they're selling at $2 billion. The gains disappear. The tax bill disappears. Generational wealth passes on tax-free. Buy, borrow, die. That's how you pay 0% while living like a billionaire. Now, you might be thinking, okay, but I could do that too, right? I could borrow against my 401k or my home equity and avoid taxes. You could try. But here's why it doesn't work for you. You don't have $2 billion in appreciating assets. You have maybe $100,000 in retirement accounts and $200,000 in home equity if you're lucky. You can't borrow enough to fund your lifestyle without eventually running out. The bank isn't going to give you a 2% interest rate. They're going to charge you 6 or 8% because you don't have billions in collateral. And most importantly, Your assets aren't appreciating fast enough. If your stocks grow 8% a year and you're paying 6% interest on your loan, you only net 2% after borrowing costs. Plus, you still need income to make loan payments. The math only works at massive scale, which is exactly the point. The strategy is available to everyone in theory, but it only works for the ultra-wealthy in practice. That's how you design a rigged game. You make the rules technically apply to everyone, but structure them so only the rich benefit. Okay, let's talk about the second mechanism. Capital gains versus ordinary income. The tax code treats these two things very differently, and that difference is worth billions. Ordinary income is what you earn from working. Your salary, your wages, your freelance payments. This is taxed at ordinary income rates, which go up to 37% at the federal level. Capital gains are what you earn from selling assets. You buy a stock for $100, sell it for $200, you have $100 in capital gains. If you held that stock for more than a year, it's a long-term capital gain. And long-term capital gains are taxed at a maximum rate of 20% federal. Let me show you how absurd this is. You make $80,000 working 40 hours a week, 50 weeks a year. That's 2,000 hours of your life. You pay 22% federal income tax on most of that income, plus 7.65% in FICA. Total federal tax, about 30%. Someone makes $80,000 selling stock they held for a year. They did literally nothing. They owned the stock. It went up. They sold it. They pay 15% federal tax, half of what you pay. Same amount of money. Your labor is taxed at 30%. Their capital gain is taxed at 15%. Now, the argument you'll hear is that capital gains should be taxed lower because it encourages investment. Investment grows the economy. We want to incentivize people to take risks with capital. Okay, but here's the problem. Most of the people benefiting from capital gains rates aren't taking risks. They're sitting on stock in companies they founded decades ago, or they inherited wealth and hired a wealth manager. Meanwhile, you're taking a risk every day. The risk that your employer could fire you, the risk that your industry could collapse, the risk that you get sick and can't work. Your labor is way riskier than their passive stock ownership, but your labor is taxed higher. And here's the real kicker. The ultra-wealthy don't even pay capital gains tax most of the time because they don't sell. They use the buy, borrow, die strategy. So the capital gains rate doesn't even apply to them. It applies to you if you're lucky enough to have investments. They get 0%. You get 15% if you're investing, 30% if you're working. That's the system. Now let's talk about mechanism 3, losses, deductions, and credits. When you do your taxes, you get the standard deduction. For 2026, that's about $14,600 if you're single. Maybe you get a few credits. Child tax credit if you have kids. Student loan interest deduction. That's about it. You add up your income, subtract your deduction, and pay taxes on the rest. Simple. Wealthy people don't do their taxes this way. They have accountants and tax attorneys who find every possible deduction, credit, loss, and offset. Real estate depreciation. If you own rental properties, you can depreciate the value of the building over 27 and a half years. So if you own a $10 million apartment building, you can deduct about $360,000 per year in depreciation. That's $360,000 in paper losses that offset your other income, even though the building is probably going up in value, not down. Business expenses. If you own a business, everything becomes deductible. Your car, your home office, your meals, your travel, your phone, your internet. I'm not saying they're cheating. I'm saying the tax code is designed to favor business owners over employees. Carried interest. This is a special loophole for private equity and hedge fund managers. They get to treat their income as capital gains instead of ordinary income, even though they're literally working for it. A private equity manager making $50 million a year pays 20% tax instead of 37%. That's an $8.5 million annual tax break for doing nothing except having the right job title. Loss harvesting. You can sell losing investments to offset gains. If you have a diversified portfolio, you can always find something that's down. Sell it, take the loss, offset your gains, pay less tax. Opportunity zones. Qualified small business stock. 1031 exchanges, Delaware holding companies. The list goes on and on. Each one of these is a legal, legitimate tax strategy. But you don't have access to most of them because you don't have the assets, the business structure, or the accountant who knows how to use them. You get TurboTax and a standard deduction. They get a team of CPAs and a library of strategies. It's not a level playing field. It never was. Now, let's talk about why this exists. Because this isn't an accident. This isn't some weird quirk of the tax code. This is intentional design. The tax code is written by Congress. Congress is lobbied heavily by wealthy individuals and corporations. Those lobbyists literally write the bills that become tax law. The 2017 Tax Cuts and Jobs Act lowered the corporate tax rate from 35% to 21%. That was a $1.5 trillion tax cut over 10 years, mostly benefiting corporations and wealthy shareholders. The estate tax exemption was raised to over $13 million per person. That means a wealthy couple can pass on $26 million to their kids completely tax-free. Meanwhile, you're paying taxes on every dollar you earn. The pass-through deduction gave business owners a 20% deduction on business income. Sounds great. Except most W-2 employees don't get this. Only business owners. At the same time, the state and local tax deduction was capped at $10,000. That hurts middle-class people in high-tax states. The expanded child tax credit, which helped millions of working families during COVID, that expired because we couldn't afford it. But somehow we could afford trillions in tax cuts for corporations. This is by design. They fund the campaigns. They write the policy. They get the tax breaks. You get the bill. The system is set up to tax work, not wealth. Because workers are easy to tax. Your income is reported on a W-2. Your taxes are withheld automatically. You can't hide it. You can't defer it. You can't offshore it. Asset owners are hard to tax. Their wealth is in complex structures. It's deferred. It's offshore. It's in trusts and LLCs and foundations. The IRS doesn't have the resources to audit them effectively. So they focus on you, the person who can't fight back, the person who can't hire a team of lawyers, the person whose income is automatically reported and withheld. You work 40 hours a week and pay 35%. They work 0 hours on their investment returns and pay 0 to 15%. And the system is designed to keep it that way. Let that sink in. You are funding schools, roads, military, Social Security, Medicare, everything. They are accumulating generational wealth, tax-free. This is why the wealth gap keeps growing. It's not just because they earn more. It's because the tax code lets them keep more. Every dollar you pay in taxes is a dollar you can't invest. Every dollar they avoid in taxes is another dollar compounding for their heirs. Over 30 years, this difference is worth billions. Literally billions. Here's an example. Let's say you have $15,000 in income you could invest, but you pay $5,000 in taxes first. So, you invest $10,000 at 8% returns over 30 years. That becomes about $100,000. Someone wealthy has the same $15,000 in gains, but they don't pay taxes. Because they don't sell, they invest the full $15,000. Same 8% returns. That becomes $150,000 in 30 years. Same starting amount. $50,000 difference just because of taxes. Multiply that across hundreds of millions of dollars and you see how generational wealth is built. The game is rigged before you even start playing. You're not losing because you're bad with money. You're losing because the rules don't apply equally. So what do you do about it? Because here's where I give you the honest answer. You can't beat this system, but you can optimize your position within it. Step 1. Optimize what you control starting this month. Max out your 401k and IRA contributions. These are tax deferred, meaning you don't pay taxes on the contributions now. You'll pay later when you withdraw, but you get decades of tax-free growth in the meantime. For 2026, you can contribute up to $23,000 to a 401k and $7,000 to an IRA. If you're in the 22% tax bracket, every dollar you put in your 401k saves you 22 cents in taxes now. That's a guaranteed 22% return on day one, before any investment gains. Use an HSA if you have access to one. Health savings accounts are triple tax advantaged. You don't pay taxes going in. The money grows tax-free. And you don't pay taxes when you use it for medical expenses. It's the best tax-advantaged account available, and most people don't max it out. take every deduction you qualify for. Student loan interest. Home office if you're self-employed. Anything legitimate that lowers your taxable income, you can't play their game, but you can play your game smarter. The goal is to reduce your effective tax rate from 35% down to 25 to 28%. That's $5,000 to $8,000 a year you get to keep on an $80,000 income. Invest that difference and you'll have an extra $200,000 after 30 years. Step 2. Over the next 1 to 2 years, shift from W-2 income to mixed income. Start a side business, even a small one. Sole proprietorship, LLC. Doesn't matter. Once you have business income, you unlock business deductions. Home office, mileage, equipment, part of your phone, and internet. Invest in assets that generate capital gains instead of ordinary income. Index funds, real estate, dividend stocks. Over time, you want more of your income coming from investments taxed at 15 to 20% and less from salary taxed at 25 to 37%. This takes years. You're not going to flip from 100% W-2 income to 100% capital gains overnight. But every dollar you shift is a dollar that's taxed lower. You'll never avoid taxes like billionaires, but you can shift your tax mix so you're paying 20 to 25% instead of 35%. That's still not fair, but it's better than what you're doing now. Step 3. Vote and advocate. This is the long game. The only way the system changes is if enough people demand it. Understand tax policy proposals. When politicians talk about raising taxes on the rich, understand what they actually mean. Are they raising income tax rates, which mostly affect high-earning workers like doctors and lawyers? Or are they raising capital gains rates and closing loopholes, which actually affect billionaires? Vote for representatives who support wealth taxes, higher capital gains rates, and closing the carried interest loophole. These are real proposals that would make the system more fair. Support investigative journalism like ProPublica. They're the ones who got the IRS data and exposed this system. Without that reporting, we'd still be in the dark. And talk about this. Share this video. Explain this to your friends. The more people who understand how the system works, the harder it is for them to defend it. The system won't change unless we demand it changes. But demanding change starts with understanding what's actually happening. Look, this isn't fair, and I'm not going to pretend it is. I'm not going to tell you that billionaires earned their 3% tax rate while you earned your 35% rate. That's garbage. But you knowing this is the first step. They rely on you not understanding the game. They rely on you blaming yourself for not getting ahead. They rely on you thinking that if you just worked harder or saved more, you'd be rich too. But it's not about working harder. It's about the rules. And the rules are rigged. I pay my taxes. I optimize where I can. I use every legal strategy available to me. And I vote for change. That's all we can do. Play smart within the broken system while fighting to fix the system. If this made you angry, good. Hit that like button. Use that anger to fuel change. Drop a comment and tell me your effective tax rate. Add up federal, state, FICA, sales tax, everything. What percentage of your income actually goes to taxes? Let's calculate it together in the comments. Share this video with someone who thinks rich people pay their fair share. They need to see the numbers. They need to see how the system actually works. And check your last pay stub tonight. Calculate your real tax burden. You need to see the number, because once you see it, you can't unsee it. And that's when everything changes.